Not too bad, but it's getting there. All right. So this meeting, just for those that are new, is a what I call a retrospective. And a retrospective, if you're not aware, well, everybody kind of knows what the word retrospective means, but it has a very specific meaning under the context of agile processes and continuous improvement processes. So this meeting is the culmination or the end ceremony in an agile project. And we look at each week as being a project, right? So each week is an experiment or a project that we're experimenting with the zero DTE technologies that we practice here. And we time box it in a week so that it's a small enough period of time that we can look at that and say, okay, what we did that week and what we set off to do that week was a success or not a success or whatever. And it may have something to do with the strategies or methods that we use, or it may have something to do with the market. It could have a number of things, whether it was successful or not. And so then we look back at the week, what we did, why we did it, what was anything that popped up that was particularly unusual or successful or good or bad, and then try to come up with something that we can then move on to the next week. So that's the hallmark of a continuous improvement process, that you're continually looking back in a time box way of what you did in the past, what you did well, what you could do better, etc. So that's what this is all about. That is the retrospective ceremony in an agile process. Virtually all modern organizations now are adopting some form of agile methodologies. I happen to be an expert at agile methodologies, probably one of the pioneers of it, going back into the early to mid 90s. And in fact, when I was chief architect for Sun Microsystems, I developed their worldwide development process around agile methodologies. So I've been doing this for a long, long time. And so I saw the value in doing something like that here. And so that's why we're doing this. And that's what this meeting is all about, just so you know. Now, we don't have any kind of intense rigor around that process. Some people think that you have to have some kind of, I don't know, forms or steps that you go through, and that's just not true. Anyways, the big thing that we've been trying for this past week, and we've started on, and we will definitely go forward with, are late day trades. Late in the trading day trades, usually in the very last hour. Now, most of our trades that we take are, they start in the morning. Well, everything starts in the morning, so I'll give you an idea of what I do in the morning and what I'm hoping that you do as well on your own, or at least you will look at my example and then try to pick that up on your own. Now, most people just wait for me to push it out and then accept what I have, and as if that is the gold standard. And maybe it is, maybe it isn't. Maybe you have more insight to the market, or I've missed something that I haven't. And I expect people to point out things that I might have missed. So anyways, in the morning, well, let me just first of all talk about what the daily process is in a trade. And it's a 4-step process. So the first thing that we're doing is we want to do a market structural analysis. And really what that means is trying to figure out, you know what, I will use the board here as something. Let's see, we'll do this. We'll make it like a classroom here. And we'll create a new board. say that there's a 4-step process. Right? Step number 1, we do a market structure. And what that means is that's volume profile. So there's 4 steps. I'm writing this with my finger, by the way. My handwriting isn't that really that bad. So, and that's a volumetric analysis using volume profile. And we look at the nodes, the volume nodes and the volume wells, that's the absence of a node, and then start drawing lines that mark the edges of those features as well as the bottoms of those nodes, volume wells. And the reason why we do that is that those are the places where the market is going to find support and resistance, and areas where there's a potential breakout or consolidation. And from that, by knowing that structure, we can tell that when price moves across the market structure, what its potential behavior is. And by knowing I guess you could say, by knowing the strength of that momentum or market move, or what kind of energy came into that market, we can also make some assumptions about how price will move, and what are the odds or the relative odds of it moving through some of these structures, depending on how strong they are, right? So that's important, because then we have kind of a behavioral analysis of and scenarios that we can build up based on that structure, right? So then the second thing that we do. Well, by the way, all of this is in the Discord, and also in the course. So if you were to go to the 0-DTE-strategy channel, right, there's a post in there called the asymmetric ODTE strategy in 4 steps. So we first do the market structural analysis. The next thing we do is we do the I call it the global macro analysis. And the global macro analysis that's where we look at economic reports. We look at the global macro condition, whether it's global economics or political or anything else that could exert or put energy into the market to cause it to go up or down. Sometimes, and also the timing of that. So for instance, there might be a Fed meeting coming out that day at 1 o'clock or 2 o'clock, and we expect something to happen at 2 o'clock. Or 2:30 when they start doing their news conference. Or at 8 o'clock in the morning when any myriad of economic reports will come out. And those economic reports we become familiar with in terms of their potential impact on the market. Each report, they are not equal. I mean, some have potentially much more impact on the market than others. Particularly these days, it's all about energy and CPI, the CPI being the inflation numbers. Because all of those have a direct influence on what the Fed is going to do. And quite frankly, virtually everything that happens in the market these days is influenced by the Federal Reserve. All right? So we do that global macro analysis. When we combine the market structure and the global macro analysis, we can come up with these scenarios. And you'll see that every morning I'll post a volume profile with the various lines that I call and label them by T0, T1, T2, T3, indicating those are our main target zones for the day, and their number indicate what I think are the first, second, third, and fourth most likely places where price is going to move to. And then I'll also draw in those green lines showing the volume well lows, etc. And then after that, we'll start drawing in a white line showing the direction that I think markets will take. And I'll do more than one scenario. I may do 2, sometimes 3 different scenarios. And of course, and then it becomes obvious which are our most likely ones or most favorite. All right, so that's what it comes out of the first 2. After we do that, step number 3, if you were to also go back to the post or to the course, step number 3 is to model, do a 0 DTE model. That's an options model. So in other words, we create a butterfly that has certain characteristics. We want it to be asymmetric in nature in terms of risk to reward. We push it out of the money, away from us, so that we can get that asymmetric characteristic, whether, and at a minimum, we want it to be 1 to 5 risk to reward. We're typically looking for 1 to 8, 1 to 12, or something on that order. And the reason why we do this is that the profit curve on such a model will have certain characteristics that make it highly likely that we will at least touch a profitable area sometime early on in the market. All right. So once we've created that model, then we'll decide to stage a number of these trades and then pick one of them, excuse me, pick one of them to actually execute. All right. So number 4, the very last step, is we manage profits. That's number 4. That's the 4th step. So hopefully everybody's getting this. The 4th step is to manage profits. And what does that mean? Oh, it means exactly what it sounds like. We're trying to figure out how to take the most profit in the shortest amount of time. All right. Now, those two things compete with each other, most and time, or profit and time. Sometimes, and that is because no one knows where the market is actually going to go all the time. We have a good idea, and sometimes it becomes very obvious that the market is going to settle in or near our target area. And when that happens, we can usually stick with the trade longer, to gain the most possible profit, because we know that the profit curve is constantly rising. All right, so let me illustrate that. We'll do another one of these. So if this is a risk graph of a butterfly that we're going to put up, this would represent time as this starting at 0, right? Time 0, and then maybe this is the end of the day. Well, let's just say that doesn't really represent time. Time, this chart would represent time 0, right? So we may start with price maybe right here. We'll call this at the money. All right. And then we have a price that we have in mind after doing our structural analysis that might be our target. or what we think is or the center of our target, or some target. And it's not really important because it's not a very specific point. It could be a range of prices where we think price is going to go. And so once we've decided on that range and where we think that we can place an out-of-the-money trade, we then place a butterfly. And I'm going to show the at expiration version of that butterfly, not the actual profit line, because this only represents what it's going to look like at expiration. We may never get to expiration. We might. Who knows? But this might be, that point if at the end of the day price ends up right there, then we can say that, that would represent the pinned trade if price ended up, at the center of our butterfly, etc. But what we're really interested in is the profit curve. Because when we put this trade on, when we first put this trade on, that profit curve is going to look like this. That first line will represent time 0. That's the current time. At some time during the day, as the day progresses, I'm going to make this a slightly different shade of all right. As the day progresses, it will grow like that, and you see that it's going up. And we're assuming then, based on our analysis, that price, I'm going to represent with a green arrow, which started out here, is moving in this direction. If it doesn't move in that direction and moves in the opposite direction, then obviously whatever we did was wrong. And so we might wait maybe a little while, because often price will do this and then turn around and do this. But in any event, we can almost guarantee that it's going to do some of that, right? And if we have this placed correctly, even if it doesn't move, at some point early on, it will start gaining value. But if it moves towards our butterfly, then it will start gaining value even faster. Now, once it starts gaining value, our profit curve, our trade, our spread, let's say we buy it at, I don't know, $1. And then we're an hour into the market. Let's say it represents this red line, and now it's worth $2. Well, is that a 100% gain? No, it's not, because the spread costs you something. Let's say the spread costs you 30 cents. So that might be a 70-cent gain an hour into it. And that's pretty significant. It's a 70% return on your risk. That's fantastic. And it could be that price is only right here at that point. All right? You have to decide, man, I just made a 70% return on the money I put up at risk. Do I want to take this trade off or not? This is what we're talking about, managing the profits, step 4. And that's a big decision here, because potentially price could continue to move in this direction and move into what's called the profit tent of the butterfly and make you substantially more. Maybe this moves up to $4. So now you have a return of $3.70, and you have almost a 400% return. And it could be, you're sitting right here, and now at that point, the market might look like this. right? And you're sitting almost right smack dab in the middle. Do you take a profit? Do you take your profit then? Or is there a reasonable suspicion that price is going to end up somewhere in this zone by the end of the day? You know, and if you project it up, you know, it could end up anywhere along that line. It could end up here, could end up here, could end up here, but all of those might be substantially more than 300-400%. They could end up being 700-800, 1,000% of your risk. It could also move this way, outside, and then all of this diminishes. All right, let's go to a new chart. I'm going to clean this up a little bit. And we'll put this back on. So here we have our butterfly. And then we have our profit curve. Notice the butterfly at expiration is not what we really care about. The only thing that we really care about is that profit curve. Right? The profit curve is everything. Now, the only thing that we really care about the butterfly at expiration is that we know that as the butterfly as the profit curve grows, as time goes, that it's eventually going to fill that butterfly. But we know that, you know, the distance between here and here, the break even at expiration, is not important to us. What's important is the break even here and here, which is much, much wider. So that's all profitable zone. In most cases, we're only really interested in the first half, you know, from here, because once it starts going this way, then we start, you know, that's usually what we're really interested in. As that profit zone increases, that bump, as you see, becomes steeper and steeper. And so that means that both the leading edge is steeper, and if you're at the very top, you get this point where if you go either direction, your potential profit starts, your potential profit's here, right? It can vary widely based on whether your price goes left or right. That's called gamma risk. The rate at which price changes, or the profit or your return changes based on the delta or the price is your gamma risk. And as you get further and further into the day, I'm coming up with, this is all a point, you know, that we're getting to our last day or the last hour of expiration. The closer and closer you get to the end of the day, the higher your gamma risk. In other words, that curve becomes steeper and steeper. Now, I'm exaggerating it a little bit just so that you can see the effect. So that's the risk that you have with taking trades right at the end of the day. That gamma risk is very high. And it gets more and more and more as you get closer and closer and closer. Now, some of the things that can help your gamma risk is the width of your spread, because the width of the blue part just draw it over this, you know. The width of your spread is always, you know, this here. That's your spread. That's one part of the spread, and then there's the other one. That width is very important because that's going to give you different characteristics. the narrower the spread, the higher your gamma risk is going to be, and also it also means that the smaller the area of profitability is going to be. So if you can make it very wide, obviously, you're going to have different characteristics. You're going to have a lower gamma, and you're going to have higher potential profitability. But you're also going to increase your risk, because it's going to look something like this if we were to do this again. So I'll do two different scenarios. I'll do the narrow scenario versus, I'll do a slightly different color. Oh, what's going on here? Oh, there we go. Versus the wide. Right? That's going to be the effect. Let's say that this is your at the money when you put on this trade. The narrow is going to, well, the wide is also going to be a bit different here too. It's going to be taller, much taller. So this isn't really to scale here. The narrow one is going to be more like that. It's going to be small. That the total potential is going to be smaller than the wide one. Why is that important? Well, consider this. You have a fixed amount of time to go, say from T0 to T end, from here to here. So as time is ticking away. If during that time you have X amount of profit to achieve compared to Z amount of profit to achieve in a given period of time, let's say halfway, this one is going to be, you're going to have X is going to be much less than Y, or Z, I'm sorry, Z, in any given amount of time. So in other words, and you know, you might not see the relative difference here, but let's say that, you know, X is 1/5 the size of Z. Then the amount of time, or the amount, you know, you're going to be making more money, or potentially making more money faster with a wider spread. All right. You're also taking more risk. So you have all these things that you're weighing, and of course, the closer you are to the end of the day, you can actually afford to make it slightly narrower if you have a good idea of where you think price is going to end up. Now, that is another trick. The cool part about this is that at the end of the day, we could take very, very small risks with narrow spreads if we think that we know where price is going to end up within a reasonable level of certainty. In most cases, we can put on a 10 wide or a 15 wide, maybe even a 20 wide spread, and get a 1 to 10 or a 1 to 8, but usually more likely a 1 to 4 or 1 to 5, depending on the day, risk to reward. Now, if we nail it, we can make a lot of money, and we did that this past week. I think we nailed it, and I don't know, made 700-800% in half an hour. was fantastic. If you miss it, then you miss out on whatever risk that you took. Let's say $100. The closer you get to the end of the day increases your odds of hitting it if your butterfly is positioned over one of these areas that you think or that are more highly likely to attract price. What are those areas? I want you to appreciate the complexity that you're going through. You're fighting time. You're fighting, the shape of your butterfly. You're fighting the market structure. You're fighting events that are happening out there, and then you're fighting this other unknown variable that can come into play as well. So there's a lot going on. In general, I don't know what the odds are that we can, in the last 30 or 60 minutes of the market, that we can reliably get inside of that profit tent and have a reasonable risk to reward and get return. What is that number? Is it 70%? Is it 200%? Is it 1,000%? How often can we hit 70%? If we could hit 70% like every time, I would do that every day. Who wouldn't do that? If you could hit 70% return, like 90% of the time, heck, I'd go in for, 15, 20 minutes and make 70% and get out and call it a day. That would be the most fantastic trading experience in humankind ever. If you could do that once out of every 5 times and make 800%, would you do that? Damn right I'd do that. 1 out of every 5 times and make 800%. Just, consider the numbers. So 4 times I'm missing out on, say, $100, but 1 time I make $800. Yeah, I would do that. So in other words, you're making about 100% on your money if you do it 1 out of every 5. So hopefully you're appreciating the power in doing this asymmetry and getting your risk down as small as possible. Now it's possible, instead of using the symmetrical butterfly, that you could employ other things, other types of strategies, and we've tried other types of strategies like a back ratio. Excuse me. like a back ratio, and the back ratio looks different. Let me show you. Before I get to the back ratio, there are other things that we could use, like a broken wing butterfly or an unbalanced butterfly. With an unbalanced butterfly, particularly, we could set something up that looks something like this. Hold on. Let's get a dark color. We'll get the risk graph here. With an unbalanced butterfly, we could set something up that looks like, oh man, how did I miss that? There. That might look like this. All right, and this would be at the money. If we're reasonably confident the price isn't going to move in this area here, let's make that red. In this area here. And we think that it can stay maybe somewhere between here and here. It's a pretty big area. Then our profit curve will look something like this. And actually, when it first starts off, it's going to look like this. All right, it has a big drop off. But as time goes, the profit curve is going to be weighted on this side. And as it grows, it's going to be weighted like this. I don't know if that makes sense here or not. But let's say that it never moves its way into the curve here. Let's use a different color. Let's say that it never makes its way deep into this, and we don't experience this gamma risk here because it's falling off because of this edge over here. You know, that's bigger risk. Over here, we might have a credit. So we could literally put one of these things on if we put it far enough out of the money and hardly ever expect to ever experience something over here, that even if we're totally wrong, we still make money, or there's no risk. But there is risk if it starts moving this way. However, the payoff might be much bigger. In other words, this payoff here might be much bigger if we can hold it to the end. So that's another strategy. Let's go to a different strategy. Let's look at a back ratio. So here's at the money. A back ratio will look like this. We usually try to put it on for a credit, but it'll look like this. All right. And the profit curve will start off looking like this. But then as the day goes on, it'll start looking like this. Well, going up like that. So we get this well here. So what we're looking for is a quick move with this, right? We're looking for a quick move early on while the profit curve is still, doing this stuff, so that we can climb up there. And you can make very quick profit. If you think that there's going to be an explosive move early in the session, then that back ratio works out really well, and you can take money, take your trade off in the first hour or two of the session and make a lot of money. But once beyond that, you really don't want to hold on to it, because then the profit curve is going to start dipping into this pit, and then you could experience a very large loss. So you can see that each one of these strategies has its pluses and minuses, and useful for different situations. Now, we've tried all of these. We've tried the broken wing, we've tried the unbalanced, we've tried the back ratio. The symmetric is the one we always go back to because it is so well known and it is so determinate. It is defined risk, and it's a lot easier to play. Does anybody have any questions about this? I mean, is this useful to you? I'll wait for answers or questions. So here we have all of these different strategies that we can use. They have different characteristics of how their profit curve behaves throughout the day. It generally grows into the at expiration cyan line that I've been drawing, the at expiration version of these strategies that we put on. Price moves based on energies that come into the market and the market structure. And so we hope to predict that somewhat. Our predictions are usually pretty good. Maybe the timing isn't always perfect, but the predictions are pretty good. I would say that the predictions that I put out are at least 80%, maybe 90% accurate, but not always in the time frame that we want. They are probably more like 70% accurate within the time frame that we want. But that still represents an incredible opportunity because of the risk to reward that we choose to play. And that growth can happen very quickly. And so managing those profits and managing where we are on the growth of that profit curve is so important, and understanding how it can potentially behave or how it will behave based on the shape of the at expiration, as well as here's an additional component that I have not yet talked about, and that is whether volatility is increasing or decreasing. So there's an additional piece of information that you need to become experienced with, because if volatility is increasing, it will help some of these strategies. If it's decreasing during the day, it will also help some of these strategies. But conversely, it could also work against the strategies. For the symmetrical butterfly, decreasing volatility helps the strategy. The profit curve rises faster when price is going up and volatility is going down. So in other words, the butterfly gets filled faster with the profit curve. So if you're near or inside of that butterfly, inside the tent, you're going to experience faster profit growth with decreasing volatility. Liquidity is also an issue. Sometimes, in January, for instance, we had super low liquidity. And no matter what happened with price, the profit curve started to depress. And so no matter where you were, you could be right smack dab in the middle of the butterfly, and you have a negative gain. Now, if you had held it all the way to expiration, the worst that could happen is price could move outside of the profit tent, and you would have a max loss of whatever your max debit was. Or if you were inside of it, you could have received the max profit. But during the day, you're looking at this depressed, saying, "Man, I want to get out of this trade because I'm at a loss." But realizing, well, you could just hold on to it and just wait. Or if you put on one of these broken wing butterflies, you're worried that not only will it, not end up under the profit tent, but it could move all the way to the risk side of my trade and cause a huge risk. And that's one of the reasons why we've done away with the broken wing butterfly, because there's always that that chance that you could fall into the bad side or the risk side of your trade, and why we opted for the symmetrical, because then that can never happen. All right. Jeff is asking, does IV or expected move affect which one you use? Well, I was just talking about volatility. When I talk about volatility, I'm talking about implied volatility, because that's what actually affects whether or not premiums are changing or not. And some strategies, like the butterfly, it is what we call vega negative. That means that when it benefits or the profit increases faster when IV is negative or decreasing. Some strategies it does it if it's increasing, right? So all of those you have to understand. So that was the additional piece of information that we had to bring into this whole discussion. So some people, got something in my throat. That's why I got the water. A lot of prospective members or people that are thinking about choosing the service want to know, well, what's your win-loss record, or what is your what is the performance of the strategy? There's no way to give that to anybody because it's not a systematic strategy, first of all, and even if it was, you really couldn't give it. It's discretionary, and there's so many moving parts, and it really comes down to the acumen and the skill and the experience that people develop doing the strategy. In general, it has a very high expected outcome. So even if you're a relatively poor trader, you can still probably do okay with it. If you're a good trader, you can do unbelievably well with it. But there is no way to give what the what should someone expect when they start with the strategy? No one knows. Depends on how much effort you want to put into it. But you could reasonably expect, in a very conservative profit-taking methodology, to do very well. And in fact, I think in the long run, someone who's conservative will do better than someone who's trying to go for the pin trade all the time. But there's some optimum between trying to go for the pin trade and going for the super conservative that is optimum, where you're going to make the most money. There's something to be said for just going for the pin trade. I think that if you just let things play out, depending on how well you can place your strategy on your market structure, will determine how successful you are at price ending up somewhere inside of the profit tent. Now, a pin trade is a special type of trade that comes within just a few points of the apex, and that gives you unbelievable profit. But if you end up anywhere inside of the profit tent, you're going to be very successful. If price never gets inside the profit tent, you can still be successful by exiting that trade before before the time runs out, and while it's profitable outside of the profit tent. So there's a wide spectrum of positive outcome. There's much less negative outcome unless you do some things that sort of violate the cardinal rules that I have set. And one of them is you got to trade small. And trading small is all relative to your account size, obviously. You also have to be not greedy. In other words, if you choose to, wait too long on some trades, and on top of that, trade too big, you're going to have a negative outcome, I think. So there's a balance between, in general, I'd say that trading small works out almost automatically. But trading big requires that you're exceptionally good at profit management. But I think that it's just too much risk, and that's one of the things that we're trying to get away from in this strategy. That trading small and semi-conservative is by far the best way to play this. And it has a lot of different benefits. One is that I think that there's a much higher positive outcome. And on top of that, there's much less anxiety associated with that type of attitude or strategy, because you're not getting yourself into trouble ever. And so you can, when you're not getting yourself into trouble, you have a better outlook, you're calmer, there's no anxiety, and because of that, you can make better decisions. It all feeds on itself. So hopefully that makes sense. All right. We're at an hour, and so I'm going to wrap this up. If anybody has any questions, please start firing away, and I'll try to answer them. I'm surprised there hasn't been more questions. Usually we have a ton of them. No questions. Might be the delay. Might be the delay. All right. I'll give it another 30 seconds or so. Can you give an example of the steps? I literally give an example of the steps every single morning. Every single day. You know, I went through, if you rewatch this, everything that I talked about emboldened the steps. I mean, in the morning I do the structural analysis. I put out all the economic reports, come up with the scenarios, and then come up with trades that fit into those scenarios and ask you to stage them and get ready to put them on. We do it every day. On my morning setup are the T1 and et cetera. I mention, and it's on the graph. You'll see the chart. Go back and look under the analysis, 0 DTE analysis channel. You'll see my analysis for every single morning that we've been in business. That's where you should be looking. When I post it, I address it to everyone. I refer to it in the talk channel back to it. I talk about in the talk channel trades that we can stage that will exemplify the ideas, model the ideas. And then I suggest, trades that we can get into by actually posting an alert in either the Catalyst alerts or the Swag alerts channels, usually in the Swag alerts channel. So every day is a literal exercise in following the 4 steps. And it's so well documented and out there in your face that you can't miss it. All you got to do is pay attention. All right? And it all starts around between 7 and 9 in the morning. And then if we do a late day trade, we basically do the same thing, although we already have done the structural analysis and all that. Now we're looking to just model a trade based on the changing or settled conditions of the day and see if we can pin something at the very end of the day. All right? All right, so that's it. Hopefully that this was useful to you. I think all my lighting is starting to turn off because it's all battery powered here. And tonight I'm going to be looking at when the futures open up, see if there's anything to report. Otherwise, tomorrow morning I will start with another structural analysis, a global macro analysis, and then scenarios, and then have you stage some trades. And then once we think that we're in a good position, we will take some of those trades and then hopefully make some money. Thank you very much for showing up. Peace to you all. Hope you have a great rest of the day. And I'm really looking forward to tomorrow. It's going to be awesome. Oh, by the way, do not forget, if you're a new member or a new trial member, you can, or if you're a monthly member, you can always switch over. Yearly members can't switch over to the new yearly deal. They'll get a deal if they re-up their subscription after a year. A very nice deal. But I have an anniversary deal going on right now. I mean, it's a pretty good discount. You should take advantage of it. Most of you will make the price of an entire year's worth of subscription in one trade. So take advantage of that. I'm going to email it out again to you. And I'll put it into the Discord. It's a great deal. Let's get it in. It's only 4 more days, and then we'll revert back to the normal deal, which is also a great deal. This is just better than the great deal. All right. Thanks. Peace.